When a government-linked bank formally puts its balance sheet behind a government-linked developer's off-plan projects, that's not a financing announcement. That's a risk signal. Emirates NBD and Dubai Holding just announced an integrated mortgage financing model for off-plan residential projects across Miras, Nakhil, and Dubai properties. The headline is about earlier buyer access to mortgages. That's the retail rate. Here's the capital allocators rate. Emirates NBD is a government-linked institution. Dubai Holding is government-owned. When a bank of that caliber formally integrates its lending criteria, eligibility checks, milestone-based approvals, responsible lending standards into a developer's off-plan sales process, it is making a structural statement about that developer's delivery credibility. Banks don't align their balance sheet with projects they don't believe will complete. The financing model only works if the asset delivers. Emirates NBD has now made its own financial assessment of that probability and published in the form of a product. 1 week earlier, they announced the same structure with Sobha Realty. For a capital allocator, evaluating off-plan exposure, developer delivery risk is one of the most difficult variables to assess independently. Third-party validation is scarce. A government-linked bank embedding its lending standards into the purchase process is as close to institutional underwriting of delivery risk as the off-plan market produces. That's the signal worth reading. Developer delivery risk is hard to assess independently. Watch which institutions are willing to put their balance sheet behind the answer.